In section 7.5, we examined how monetary policy operates in Australia. In this section, we're looking at how it operates in Singapore. And we're doing that to contrast the ways monetary policy operates in the two countries. I certainly don't want you thinking that monetary policy is all about interest rates moving up and down to affect the position of the AD curve to affect inflation. That's just one example of the way monetary policy can be used. Singapore do it in a completely different way. What I've got here in this graph is over time, I'm looking at the exchange rate and how the exchange rate changes over time. And this blue line is actually a hypothetical movement of the Singaporean exchange rate against, let's say, a basket of other currencies. Now, that could be a trade-weighted basket of other currencies. If that doesn't make sense to you, don't worry about it. Just think about this as the Singapore exchange rate against, say, the US dollar. Okay, and with what I've got here is two dotted lines. And these are upper and lower bounds for movements of the Singapore dollar over time. So the central bank in Singapore doesn't manipulate interest rates up and down to affect the aggregate demand curve to affect inflation. The way they operate monetary policy in Singapore, I'm talking about the Monetary Authority of Singapore, MAS, web link down here to the relevant publication. The way they operate it is to restrict movements in the value of the Singaporean exchange rate to between this upper and lower band, the upper and lower dotted line. So I guess a couple of questions there. Well, first of all, why do they do that and how do they do that? Well, first, why do they do that? Imagine the Singapore exchange rate was moving through time like this, and we get to this point in time at the red dot. And then the central bank in Singapore allowed, through free market forces, the exchange rate to just move up, up and up, appreciate, and break through this upper band. What would happen? Now, to answer that question, you need to know a few things. If you've ever been to Singapore, you'll realize that it is a small open economy. And in Singapore, for every dollar that is spent, around 50 cents of that dollar is spent on imported goods. Now, in Australia, we're nowhere close to that. So think about all of the things Singapore purchases. And if you've actually lived in Singapore or visited Singapore, it's really going to help because you'll be able to visualize what I'm talking about. But if you travel around Singapore, where is the food produced on the island? Where do they get the fresh water from? Where is clothing made? Where does the footwear come from? Food is an interesting one. In Australia, most of the food that you eat actually comes from Australia. It's actually grown in Australia. In Singapore, the vast majority of it is imported. And so many basic necessities are imported into Singapore. And what Singapore is very good at is more advanced manufacturing, advanced sort of services provision, health, that sort of thing, high-tech equipment, computer equipment, et cetera, et cetera. But production of things like food, clothing, footwear, a lot of those basic necessities do come in from other countries. Now, of course, we import our own. We import in Australia clothing and footwear, but food is a big one. And that's a very good example, probably the best example I can give you of the difference between Australia and Singapore. So with the exchange rate then moving through time, if you allowed it to appreciate by, say, 30% over the course of 6 months, what would happen to food prices? Food which is imported. Well, if the exchange rate goes up by 30%, the Singapore dollar price of that food is going to fall by 30%. See where I'm heading with this? And overnight, you've got a deflation problem. If you're spending 50% of your internal spending is on imported goods, if you allow the exchange rate to appreciate by, say, 30%, then 50% of what you buy in Singapore is going to drop by 30% overnight. And immediately you've got a deflation problem. That deflation will just filter throughout the economy, and eventually the problems associated with deflation that we've been discussing in this course will start to appear. Now, we do have a similar effect in Australia. When the Australian dollar goes up, our import prices do fall. But it doesn't push us into deflation like it would in Singapore, because we're not so reliant on imported goods. More of what we buy in Australia is actually made in Australia, and we're less reliant on imported goods. So hopefully that is beginning to sort of resonate and make a bit of sense. If we then get to this point in time, this red dot, what if the Singapore dollar drops in value by 30%? Then you've got the opposite problem. 50% of what you purchase in Singapore, all of those imports, are going to increase in price by 30% overnight. And when I say overnight, I'm being overly dramatic. It's not going to be overnight. It's going to be over the course of that 30% appreciation. But you will get, as a result of a big depreciation of the Singapore dollar, an inflation problem very, very quickly. So by controlling the exchange rate, you're actually stabilizing import prices and therefore stabilizing the inflation rate. The problem with the exchange rate in particular is that it can swing wildly. In Australia, for example, Australia is a bit of an extreme case because we've got a very volatile exchange rate. Why? Because our exchange rate, the value of our exchange rate, is linked to commodity prices. When commodity prices go up, our exchange rate goes through the roof, vice versa. And commodity prices are notoriously volatile. Just have a look at the price of wheat, the price of iron ore, the price of natural gas. Get a time series over a long period of time. You'll see huge fluctuations in the prices of those commodities. So exchange rates can be very, very volatile. And certainly after the GFC, the value of the Australian dollar dropped from about 105 US cents to about 65 US cents. That's about a 40% drop in the value of the Australian dollar. Now, we survived that. That did put upward pressure on import prices. That big drop in the value of the Australian dollar, it did, but it didn't lead to an inflation problem. If you did that in Singapore, however, and allowed the exchange rate to drop 40%, you'd have a big inflation problem. And that inflation problem would kick in a hurry. So by keeping the exchange rate constant, you stabilize import prices, which then allows you to control inflation. And the second point that I made just then is that exchange rates can be very volatile. They can be driven by investment money moving in and out of a country. They can be driven by changes in the demand for imported goods and the demand for exports as well. Sort of going back to the balance of payments. The exchange rate can be driven by currency demand, the demand and supply for your currency, and that is linked to buying and selling goods and services, and also investment flows. What I'm getting at is that investment flows in and out of countries, in particular, can be very volatile. So if you have a surge of investment money coming into your country or a surge of money leaving, that is going to put a lot of pressure on your exchange rate, either up or down, depending upon where the money's coming in or out. So exchange rates can be very volatile. And in Singapore, you have to control that volatility to control import prices. So why does Singapore use an exchange rate-centered monetary policy? First of all, because Singapore, I'll start with the one I've already mentioned, right down the bottom, it is very open to trade. It does a lot of importing and exporting. Now, in terms of monetary policy, the fact that Singapore exports a lot is not too much of a problem. what is a big problem is the fact that it imports a lot, and every time the exchange rate changes, that's going to change import prices directly. The fact that Singapore does export a lot, it is important, but not as important as the fact that it imports a lot. Because imports and import prices are built into Singapore's CPI. And import prices fluctuate with the exchange rate. Export prices, not really built into Singapore's CPI index. Okay, so you can get wild swings in import prices in Singapore, but export prices in Singapore dollars, they're not going to be fluctuating significantly with changes in the Sing dollar. Hopefully that just makes sense. Singapore does have limited resources, limited land as an example, so you won't see, like in WA, you won't see fields and fields of things being grown for people to eat. Most food, as an example, is imported. Do a little bit more digging, and I'll be guessing that a lot of bottled water comes from Malaysia. And certainly Singaporeans drink a lot of bottled water. So limited resources, they're very reliant on imported staples. And then Singapore is also very small in size. And what that means is that they are so small in size that they have to take prices of what they import as given. So if Singapore is importing wheat from another country, importing rice from another country, it's because they're importing small quantities relative to global demand, it's very difficult for them to get discounts, for example, or affect the prices that they're buying at in any significant way. And so because they're small country, small economy, they have to take the world price of wheat as given, unlikely to get discounts. The price of rice as given, the price of other fruit and vegetables as given. So that's why they have an exchange rate centered monetary policy for those reasons. Then, of course, if we go back to the need to stabilize the exchange rate, one of the important implications of that is you really do lose control over your domestic interest rates. You'll lose control over your domestic interest rates. And what happens, or what is happening in Singapore, is this. So the blue line is just, it's the SIBOR. Don't worry about what SIBOR is. It's just an interest rate. There's the LIBOR up there as well. It's basically an interbank offer rate, but I don't want you researching what an interbank offer rate is. It's just a type of short-term interest rate. Yes, but if you want to look up what an interbank offer rate is, feel free, knock yourself out, but you certainly don't need to do that for this course. So these are just interest rates, the blue line in Singapore, and interest rates in the US. Look at the correlation. The correlation's not perfect and some gaps open up, that's okay. But for most of the period that we've got here, some 18 years, the series are moving very closely together. And so when I see two series like this, I think to myself, well, either one series is leading and the other is following, or there is not a causal relationship between the two, but they are both responding in a similar manner to some third factor. They're the two possibilities. Or the correlation that we're visually seeing here in this diagram is just completely random, and it's just, yeah, completely random. It's just luck or bad luck that it looks this way. The way it works is that there is causality running from one series to the other. One series is changing and it's affecting the value of the other series. Now we've got the US and the Singapore here. Have a guess which interest rate series, the US interest rates or the Singaporean interest rates, which do you think is leading and which do you think is following? I hardly need to answer that one, do I? Of course, it is the US interest rate moving because of the size and the dominance of US financial markets. The US series is moving independently of Singapore's interest rate, and Singapore's interest rate is then following. So it's Singapore playing follow the leader. But why are they following interest rates in the US so closely? Because if they don't, and they allow an interest rate gap to open up, that could cause a lot of money to either move in or out of Singapore, putting unwanted pressure on their exchange rate. So for example, let's have a look from 2015 through to 2017. In 2015, we saw interest rates in the US begin to rise up to about, they're kind of moving towards 2%. Now let's just imagine that interest rates in Singapore had stayed at about 0.5% like they were in 2014 and maybe began to decline to zero. Let's just assume that that happened. Okay, then you would have interest rates in Singapore at say zero, interest rates in the US moving to 2%. That's a 2% positive differential. What would happen? You would have investment money in bond markets and stock markets. Sorry, let's just imagine it's money in bond markets. You'd have money in bond markets flowing out of Singapore because the interest rates are now really low, and you'd have money moving into the US because interest rates are now high. And all of that money moving out of Singapore and into the US is going to put downward pressure on the value of the Singaporean dollar. So the Singaporean dollar, when this positive interest rate gap opens up, the interest rates are high in the US, the Singapore dollar starts there and starts depreciating. And all of a sudden you have a deflation problem. Sorry, an inflation problem. I'll get it right. So that's why interest rates in Singapore need to move closely with interest rates in the US to prevent any large interest rate differentials opening up, so that there isn't any undue pressure placed on the value of the Singaporean dollar because of significant interest rate differentials. Now, you might be looking at this diagram, maybe not. You might be looking at this diagram, looking at this positive differential here in 2006, 2009, thinking, this guy doesn't know what he's talking about. There's even a bigger one in 2000. This guy definitely doesn't know what he's talking about. Okay, let's consider those large interest rate differentials there. What I said previously doesn't mean that interest rate differentials can't open up. That interest rate differential there, for example, if you go back in time to 2005, 2006, 2007, and looked at the economic conditions in Singapore, then you would find that that interest rate differential was required to actually create stability in the Singaporean dollar. Now that's where things get a little bit complex, because there must have been something else going on which was affecting the value of the Singaporean dollar, perhaps placing upward pressure on the value of the Singaporean dollar, which then required this interest rate differential to offset that pressure to create overall stability in the value of the Singaporean dollar over time. So for example, one thing that could have been happening here is a large amount of foreign investment money flowing into Singapore. So there could have been constructions of new buildings, new towers, et cetera, et cetera. There could have been companies in Singapore undertaking initial public offerings, so selling shares, that sort of thing. A lot of investment. I'm not saying this did happen, I'm saying it could have. So there could have been a lot of foreign investment money moving into Singapore. Now that would then put a lot of upward pressure on the value of the Singaporean dollar. And then to offset that, this sort of interest rate differential where the Central Bank of Singapore didn't increase interest rates by as much as they were increasing in the US, that kind of differential there would then place some offsetting downward pressure on the value of the Singaporean dollar to offset all of that capital inflow. So that's a reasonably complex sort of an idea. It's sort of straying a little bit outside of the boundaries of the course in terms of degree of complexity, but that would be the basic idea. If you do see an interest rate differential opening up like that, it would be consistent and probably required to create stability in the value of the Singaporean exchange rate over time. So this differential at that time would have actually been needed. But then obviously whatever was causing the need for this differential, it sort of faded away and it was gone by 2009. And for the next sort of 8-9 years, the Singaporean exchange rate and the Singaporean interest rate and the US interest rate were highly correlated. But the fundamental idea here is if you do want to stabilize your exchange rate like this and keep your exchange rate managed, this is a managed exchange rate system, then you do lose control over your interest rates. You can't move your short-term interest rates at will. You can't let them get out of line with the rest of the world. Now, sometimes this could be problematic. You could have interest rates in the US rising, interest rates in Singapore having to rise as well to take pressure off the exchange rate and to prevent an interest rate gap opening up. But the Singaporean economy could be slowing in terms of economic activity. And at the very time that your economy is slowing, you're having to push interest rates up to stabilize the exchange rate, stabilize import prices to prevent an inflation problem. So then, if you're having to do that with your interest rates and increase them at a time when your economy is slowing, then you're going to have to find another way of stimulating economic activity, because you can't start lowering interest rates in this situation and let a big gap open up between interest rates in the US and Singapore. And finally, this is a diagram taken from this publication here. So this Economics Explorer number 3, this is one you really need to read and absorb and really understand the differences between monetary policy in Singapore and Australia. It's an important part of the course. So don't forget to read that Explorer. So figure 6. And okay, so what do you need to take away from this Explorer? How monetary policy operates in Australia and why it is operated differently. So a fundamental understanding, a basic understanding of how it operates and why it is operated differently. So read that Explorer with those two things in mind. And then this final slide for topic 7, what this is showing is the ways in which changes in the exchange rate in Singapore affect the inflation rate. So there's two channels. The first, and what we've got here is S, a dollar sign. NER is the nominal effective exchange rate. Now, don't worry about what that is. Just think this is stronger Singaporean exchange rate. Over here, stronger Singaporean exchange rate, so an appreciation. So this first channel is a direct channel through imported inflation. If the Singaporean exchange rate increases, import prices fall. We know that. And as import prices fall, the prices of, say, food and water in Singapore, firms pass those cost savings on to customers, and that directly feeds through and lowers the inflation rate. Yep, we should understand that. But there's another channel through which a stronger exchange rate, what we mean by a stronger exchange rate is this, an upward movement above the upper and lower band, an upward movement. So this exchange rate here is, well, the exchange rate's now appreciating, it's going up. What's going to happen is we've got external and domestic demand. So let's read this as external demand for Singaporean-made goods and services fall. That is a reduction in exports. And external, and now we've got domestic demand for Singaporean-made goods and services fall. That is actually an increase in imports, or it will cause an increase in imports, because if domestic demand for Singaporean-made goods and services fall, then that spending would now move away from Singaporean-made goods and services into foreign goods and services. So imports would go up. But why would imports go up? Because a stronger Singaporean dollar would actually make import prices cheaper, just like we had over here. So the price of all of these foreign goods and services are now cheaper for Singaporeans to buy with stronger exchange rate. So imports increase. So demand for Singaporean goods and services falls by foreigners, that's the external, and they also fall by local Singaporeans, that's the domestic component. So both foreigners, external, and Singaporeans, domestic, both of those groups of people will reduce their demand for Singaporean-made goods and services. And that means that domestic production levels in Singapore fall. As domestic production levels fall, what is going to happen? Well, what's going to happen is your production costs may well fall a little bit. So if you've got a significantly weaker demand for your goods and services that you're selling, you may be able to cut the wages you pay to workers a little bit. You may be able to reduce the price you pay for some inputs, because there just isn't the same demand for the inputs that you use in producing final goods and services in Singapore. So maybe the prices of those inputs will fall a little bit. So domestic production costs might fall a little bit as you produce less domestic production in Singapore because of the exchange rate appreciation. And with lowering production costs, you can pass those cost savings on to customers in the form of a reduction in the prices of final goods and services. And so inflation is going to fall for that reason as well. So basically what I'm saying is this second column here, the exchange rate goes up, the price of domestic goods falls, that's the second column. And the first column is the exchange rate goes up or appreciates, the price of imported goods falls. And they work together to lower the overall level of CPI inflation in Singapore.